A lot of investors right now are asking the same question. Should I do a short-term rental or a mid-term rental? And honestly, I think a lot of people are asking the wrong version of that question because the real question isn't which strategy makes the most money. The real question is which strategy actually fits the property, the market, and the type of investor you want to be. Because I've seen investors chase Airbnb revenue numbers and burn themselves out completely. And I've also seen investors move everything to midterm rentals, expecting easy passive income, and then get frustrated because the numbers weren't what they hoped for. The truth is, both strategies can work, but they work for different reasons. And if you force the wrong strategy onto the wrong property, you can create a lot of unnecessary stress and underperformance. So in this video, I want to break down short-term rental versus midterm rental in Phoenix specifically. What's working right now, what investors are getting wrong, what the operational realities actually look like, and how I think investors should evaluate these strategies moving forward. First, let's define the difference clearly because a lot of people online mix these together. A short-term rental is typically your Airbnb or vacation rental model. Guests stay anywhere from a couple nights to maybe a week or two. You're dealing with constant turnover, dynamic pricing, guest communication, cleanings, reviews, and seasonality. A midterm rental is usually a furnished rental with stays around 30 days or longer. That can mean traveling nurses, corporate housing, relocation clients, insurance displacement, construction professionals, or seasonal residents. The property is still furnished, but the operational model is completely different. Now, the reason this conversation has become so popular lately is because the Phoenix market has changed. A few years ago, people chasing short-term rentals aggressively because the revenue potential looked incredible. And honestly, for some people, it was incredible. And as more inventory entered the market and competition increased, investors started realizing something important. High revenue does not automatically equal high profit or low stress. That's where a lot of the short-term rental versus mid-term rental debate really comes from. So let's start with revenue potential. Generally speaking, short-term rentals usually have higher gross revenue potential, especially in areas like Scottsdale. If a property is in the right location, designed well, professionally managed, and optimized properly, short-term rentals can absolutely outperform mid-term rentals from a revenue standpoint. But that higher upside usually comes with a higher operational intensity. And that's the part most people underestimate. With short-term rentals, you're managing constant movement. Bookings, messaging, cleaning coordination, supply restocking, guest issues, pricing adjustments, maintenance scheduling, review management. It's a real business. And honestly, some investors love that because they want maximum revenue. Other investors realize pretty quickly that they accidentally built themselves another full-time job. That's usually where midterm rentals start becoming more attractive because midterm rentals are often more stable operationally. Lower turnover, fewer cleanings, less guest communication, more predictable occupancy. And for a lot of investors, that stability matters more than squeezing every possible dollar out of the property, especially right now. I think a lot of investors today are prioritizing predictability over hype. Now, does that mean midterm rentals are automatically easier? Not necessarily. They're just different. You still need good furnishing. You still need marketing. You still need systems. You still need tenant screening and operational processes. But compared to short-term rentals, the day-to-day intensity is usually lower. And honestly, for certain personalities, that's a much better fit. Another thing investors need to understand is that location matters differently depending on strategy. This is huge. An area that works incredibly well for Airbnb may not be ideal for midterm rentals, and vice versa. For example, a Scottsdale vacation-focused property near entertainment and tourism may thrive as a short-term rental. Meanwhile, a property near hospitals, business centers, or major employment corridors may perform better as a midterm rental. That's why I always tell investors, don't fall in love with a strategy before you analyze the market. The market should help determine the strategy, not your emotions. And honestly, this is one of the biggest mistakes I see online. People become emotionally attached to Airbnb because they see massive revenue screenshots. Or they become emotionally attached to midterm rentals because they want easy passive income. But good investing usually lives somewhere in the middle. The best operators stay flexible. The flexibility matters a lot right now in Phoenix because some properties honestly work best as hybrid models. This is becoming more and more common. Maybe the property operates as a short-term rental during peak tourism seasons, then transitions towards longer furnished stays during slower periods. That adaptability can create stability while still allowing upside. But again, it requires strategy and execution. Another thing nobody talks about is investor personality. This matters more than people think. Some investors genuinely enjoy hospitalities. They like guest experience. They like optimization. They like revenue management. They enjoy the fast-moving nature of short-term rentals. Other investors hate it, and they want simplicity, predictability, less communication, fewer moving parts. Neither approach is wrong, but forcing yourself into the wrong operational model usually creates frustration. And honestly, I think a lot of burnout in this industry comes from investors choosing strategies that don't align with how they actually want to live. Not every investor wants to be glued to their phone dealing with guest issues at 10 p.m. And there's nothing wrong with that. Now, from a risk perspective, both strategies have trade-offs. Short-term rentals can produce stronger upside, but they're usually more sensitive to seasonality, competition, market shifts, and operational mistakes. Mid-term rentals can provide more consistency, but sometimes lower peak revenue potential. So again, there's no universal answer. The right answer depends on the property, the location, the investor, the goals, and the operational plan. That's why I always push investors to think beyond just spreadsheets, because numbers alone don't tell the full story. The operational side matters massively. And honestly, this is why management becomes so important. A poorly managed short-term rental can underperform badly. A poorly marketed mid-term rental can sit vacant. Execution changes everything. That's true whether you self-manage or work with a professional management company. The strategy itself is only part of the equation. Now, personally, what I am seeing right now in Phoenix is that the investors performing best are the ones staying adaptable. They're not emotionally locked into one model. They're analyzing market behavior. They're looking at demand trends. They're understanding neighborhood dynamics, and they're choosing strategies intentionally instead of reactively. That's the difference. And honestly, I think the investors who approach the market this way are going to have a major advantage moving forward, because this market rewards strategy right now, not hype, not shortcuts, not easy money. So if you're trying to figure out whether a property should be a short-term rental, a mid-term rental, or maybe even a hybrid model, I'd encourage you not to make that decision based purely on social media content or revenue screenshots. Look at the full picture: the market, the operations, your goals, your lifestyle, your risk tolerance, and the actual demand drivers around the property. Because the best investment strategy is usually one you can execute consistently over the long term. And if you're serious about buying a furnished rental, or you already own one and you're trying to figure out which direction makes the most sense, I put together a short intake form below. It takes about 2 minutes. That helps me understand your goals, your budget, what type of property you're looking at, and what you're actually trying to build before we schedule anything. Then, if it looks like we're a good fit, I'll personally reach out and we can map out the best strategy together. Because today, especially, the investors who win are usually ones making strategic decisions instead of emotional ones.